Hi there, it's me, Stephen Thomas, with Reports on Housing, and I'm here with another housing debrief. Thank you for joining us, really appreciate it. This week we're going into housing demand stalled. Now, we take readings every week, but every other week we go even deeper, and that was the report that we're kind of looking at as of today. And we're looking at what's happened over the last couple weeks, and really what we're seeing now is housing has really stalled, and that we knew this was coming because interest rates are remaining above 7%. Now, don't get this confused with Freddie Mac's interest rate reading that they do every Thursday. That is typically with 1 point. What we look at is interest rates on a daily basis without points, and we have to look at it daily rather than once a week, like what Freddie Mac produces. Because what happened a week ago and what happened today is two totally different dates and different points on the interest rate chart, because they're so volatile that they're all over the place. So we like to take a look at them on a daily basis because it really helps us with different trends rather than on a weekly basis, because we really can see the trends when you're looking at it as often as we are. So housing demand has stalled, and it's on the backs of this of the United States outperforming what everybody's expectations were in 2023. Now, the Fed came out in December, and they kind of changed their language a bit. A lot of people said they pivoted, but they really only pivoted in language. That's all that they've done. They've said that they're going to do 3 rate cuts for 2024, and 3 months prior in September, they said they were going to do 1. So that big change and the change in their language made a big difference, and a lot of Wall Street and everybody got overzealous and said, all right, here we go. And we saw rates and everything dive, and we saw the stock market doing really well. And then the Fed stepped in and said, too much. You guys are overdoing what we're talking about, and you're overthinking it. First, we have to see more in the data. So things have really changed. As a matter of fact, we've been very, very data dependent. You can see that in the data. We've created a lot of jobs, a lot more than everybody thought for the month of January, as well as CPI came in. It was a little bit too hot as well. Had to do a lot with the rental index, which is a totally weird index to begin with. I won't even get into the weeds and talking about it, but know that it's the most. It is a really lame index to utilize for CPI. They should probably update it. They haven't, and it did something weird at the first time it did it in 30 years. You have PPI that was really too high. We had job openings that were really too high. There's a lot of things that were really too hot. The Fed met at the very end of January 30th and 31st, and they kind of walked back some of the things they said in December. So only retail sales were really down when you look at that. There are other charts that you look at as that paints the picture of that there's some definite big headwinds coming. But unfortunately, we look at these other big giant charts on a monthly basis. This is what Wall Street does, and they make a lot of their financial decisions based upon what they're seeing in the economy. So everything's been too hot, which means that when the Fed actually does make those rate cuts, it now looks like it's pushed further and further on because the economy has been too resilient. Now, too resilient for what Wall Street thinks. For us, we thought that we're not going to see it in the numbers until we get to later on this year, not in the months of January and February. It was nice to see rates come down as early as they did in December and start in January, but that's not what we were anticipating. It actually did it earlier than we thought, so we got this real quick bump, but it changed as rates continued to drive higher. So we've already seen a significant change in the data that we can see, we can read. You can't really feel it as much in the marketplace, but we could definitely see it. So we followed then the 10-year Treasury. Based upon what's going on with all those charts is what happens with 10-year Treasury. And 10-year Treasury, what happens with these 10-year Treasuries is what happens with mortgage rates. As this yield goes down, interest rates go down. So when it's red like it is right here, where it says down 0.022, we had a slight reduction in rates today. That's just today. When this is green, and that means that the yield goes up, we have interest rates that typically go up. It doesn't always happen this way, but this love affair between mortgage rates and 10-year treasuries goes back to 1972. And there's a real stickiness to this. Right now, it's a little bit off, the difference between 10-year treasuries and where mortgage rates are. But down the road, when things are a lot more certain and we know exactly kind of where we are, that we're going to see that this spread between the 10-year treasury and mortgage-backed securities starts to narrow, which means that interest rates down the road can even go down further without anything happening in 10-year treasuries, just because we know where we are. So this is the 10-year treasury. This is where we were as of today. And you can see we've been bouncing really close to that 4.25. And where were we? So we're right now, we've been above 7%. We've been above 7% from the middle of February to here, so the last couple of weeks. Now, we were stuck above 7% for a long time, and I'm pointing to it. This was about July 29th. And from July 29th all the way until we got to the second week of December, so it was 5 months where it was just above 7%, and it really slowed our market, that 7% threshold. And from that point on, it just kept on driving up higher and higher until we got to 8%. It started to come down because the Fed started talking it down, and the Fed, then we started to see some of the data come in where it showed that things were slowing a little bit more than what people anticipated, and rates started to fall even further until we got to the middle of December, and then they fell below 7%. Now, within, so this is where they fell all the way towards the end of December, where we kind of hit a low, and we were at right about 6.6% as far as interest rates were concerned. And then they kept on rising from that point forward based upon the really positive economic news, one report after another that were positive. So rates and where they are today, we're at 7.1%. So there we are, sticking at 7.1%. Just like I showed you, that yield on 10-year treasury was down. So was the mortgage rate for the day was down slightly from, I think it was like 7.16% down to 7.1. So somewhere around there. But this is where it is as of today. It's 7.1%. You can see how volatile it is on a weekly basis. It's kind of jagged all over the place. And this is why we follow it on a daily basis, because it's constantly changing and it's moving based upon all the different charts and data that is out there. So this is where we were exactly 1 year ago. We were at 6.94%. Now, then we got into March, and as soon as we got into March, it went above 7% for a hot minute. And so it's very close to where rates are today, but it was a lot lower in February of 2023 than it was in February of 2024. It's about 0.5% lower in 2023. So when you have that, when you're above 7%, there's this mentality that occurs. That 7% is the psychological barrier where when it has a 7, people look at it, even if they pay points, yeah, they have to pay points to get the interest rate down. It doesn't come down far enough. So 7% is this threshold that really psychologically people don't like. Consumers don't like. It eats into what people are able to afford. And this is a real psychological barrier. Now, likewise, 6% is another psychological barrier. And that is when we get below 6%, it is going to be bananas for real estate. And you can see that we haven't been there at all anytime recently. We were actually there for a minute, but within the last year, we haven't been there. We were there for a minute, and that first green arrow, actually the green arrow on the right, is February 2nd of 2023. We were there at 5.99% for a day. And then right after that, we got this really strong jobs report, and boom, things were up right after that, and they never been below. So we were only there 5.99% for one day. I wouldn't even technically call it below 6% because it was right there. And prior to that, it was the end of August of 2022 that we were below 6%. So it's been quite some time. If you really want to know where we really have been below 5% for a period of time, it's August of 2022 was the end of it. But you could see that it ran pretty much only for a minute was at above 6%, and that was in June of 2022 until we got later on after August of 2022. From that point on, we've pretty much been above 6%. That's where things really change. But when you're stuck above 6% even, it's really it slowed our housing considerably, and above 7% decelerates it even more. It's very hard to ascertain or feel that difference, but it's absolutely there. And now, before I get into that slowdown and what it does to housing, let's bring in our sponsor. It is Jason Thibodeau from JMJ Financial, and he can be contacted at 714-330-8263. That's Jason Thibodeau. JMJ Financial, 714-330-8263. And he has a podcast, and he just started his podcast. It's Jason Thibodeau and Matthew Morrell. They get together. They're interviewing different people. They're talking about great things. They're mortgage loan officers and entrepreneurs with decades of experience. They're focused to lead with a heavy emphasis on providing meaningful education and value to the consumer and real estate professionals alike. Our industry has a tendency to be very transactional and salesy, and they're determined to help change that with their approach. Their approach is relationship and integrity first, as they've found the business always follows from there. That's Jason Thibodeau and Matthew Morrell. They do this. I was part of their very, very first podcast. And you can go to wherever you like to listen to podcasts. It's, of course, the Mordeaux Mortgage podcast. So please take a look at that, the Mordeaux Mortgage podcast. JMJ Financial, Jason Thibodeau and Matthew Morrell. And you want to get in contact with Jason Thibodeau, JMJ Financial, 714-330-8263. So once again, back to housing and how it's really been kind of locked down. It's not performing the way that everybody would like a housing market to perform. And it's not just these high interest rates and making things unaffordable. It's really on both sides of the equation. Both supply is limited, demand is limited, and it makes it very hard to transact. Not a lot of transactions taking place. You have to go back decades to find the number of transactions taking place, and that is because of these prohibitive rates being so high. And when they get above 7%, it slows things down just a little bit more. And so let's talk about what it's done to the demand. And you can see right here, this has a lot to do with affordability, because when interest rates were at 6.5%, if you're looking at a $5,000 per month monthly payment with principal and interest, and that's 20% down, and that's pretty much if you're in Southern California or the Bay Area, this is what you're looking at. You were able to afford a $988,000 house in when things were at 6.5%, but now they're 7%. They're now at $940,000, and you can see that once you get below 6%, you're now above $1 million, and that's really, it just opens things up as interest rates fall. But we're stuck at 7%. You can see how it's limiting affordability, and that limiting of affordability means that fewer consumers out there can actually afford to purchase a home. There still are people that are. There's still cash that's taking place. There's still investors. There's a lot of people that are still doing it, but it's not a whole heck of a lot. The increase in demand comes from as rates fall, and it invites more potential borrowers to purchase and be able to afford these values at their these higher values. And so right now, we have a lot of buyers that just simply can't afford to purchase, so they're going to wait till rates come down a little bit more, because I told you 7% is a big psychological barrier, so they start sitting on the fence for a little bit until interest rates make their way down. And you can actually see it. This spaghetti that I'm showing is demand, and I did every single year going back to 2013. And you can see that if you take out that the yellow line, that was 2022. That was higher rates. You could the green line, which was COVID, and you can see that the green line on the right, that is way the second half of the year was really strong demand, and that was because we had no demand during the springtime because of the COVID lockdown. So you ignore that. The blue line was last year. I'm pointing to the blue arrow, and that was 2023. The purple line is this year. So you could see where last year and this year, it's really muted. And last year it was muted all year and kind of at a cruising altitude at this time. And that's kind of what has occurred again. You could see it, I'm pulling all that spaghetti away, and I'm just going back to 2021. And you could see here that today we're at 10,482. In all of Southern California, and as large as it is, it only went up 1% or up 74 pending sales. Last year at this time, we were at 11,091 in Southern California. That's 6% higher. So demand is just a snapshot of pending sales activity the last 30 days. And I took that same snapshot 1 year ago, and this is where we are today. And you can see the difference is 6% more. So not a whole heck of a lot, but yet more. That's really what the bottom line is. An extra 600 pending sales will make that difference. But that is an extra 600 pending sales spread all over SoCal. And you can see slightly below last year and looking very similar to last year. And if you really look closely, even in 2022 and in 2021, and normally at this time, demand continues to rise. But the problem was last year and this year, we really had interest rates rising. We did too in 2022. But there was nothing available and everything was being placed in escrow, and there's this psychological transitioning, and we were still well below 6% rates. So, and even at that time, below 5% rates. So things were still affordable. So that is where we were last year and this year, the purple and the blue. And the 3-year average prior to COVID, 2017, 18, 19, when I put all the spaghetti there, that's the green dot there. And the 3-year average is 15,527. It's almost where 2022 is. It's a little bit higher than that. So it's very, very similar to where we were in 2022, and that's how far off it is. That's 48% more pending sales activity. It has to do with two things: fewer homes that are on the market, as well as rates being so high that demand has diminished due to affordability. So we've already reached this cruising altitude in demand, when normally it continues to go up a little bit higher and peaks anywhere from March, till the middle of March to the end of May. That's very, very typical, and sometimes a little bit before, sometimes a little bit after. But typically it's right during the springtime that we see that peak. And so, but we've already hit that cruising altitude, and it's not going to change much because that's just the nature of it, as long as rates remain where they're at. So we have demand that's diminished, but we also have very few homes, because people are going, buyers are sitting there going, well, things are really slow out there, but they're not. I'm just showing you that demand has stopped and it's plateaued, but you have to match that really low demand against a low supply. And this is where people don't understand really what's going on, because at the end of the day, it all boils down to supply and demand, and we need a lot more supply. And all these doomers are talking about how everything is going to go to hell in a handbasket. The only way you pave a path to more supply is if the entire economy were to collapse. And there are some doomers that talk about that, and they sound extremely smart and intelligent, and they have 10,000 views and all that. But the problem is they're actually not true economists. Even if they can sound really intelligent, they really are having troubles finding the exact economic macro look at the whole entire picture that would really collapse the entire economy, like we saw during the Great Recession. So people like to point to those kind of things in order to bring on a lot more inventory, and we just don't quite see what these people are talking about anywhere in the cards currently right now. And as far as the available number of homes, this is where it is today. Now, this is different. So for SoCal, today it's at 20,534. It too went up 1%, just like demand. So we've had a little bit more demand and a little bit more supply. And last year we were at 19,742, which is 4% less. Now, the difference was last year the inventory was actually falling, that's the blue line, until it got all the way till April. This time, it's actually increased slightly, and now it's crossed over last year, and most of the country is above last year's level, but SoCal had a hard time getting there, and it just got there. The Bay Area had a hard time getting there too, and it just got there too. So that's what's kind of going on there. If you see the 3-year average prior to COVID is just about 35,000 homes, that's 70% more. That's way up there. That's a lot more inventory where we were prior to COVID, 2017, 18, and 19. That 3-year average. So we've got this low diminished demand, but we're putting it against a very low supply compared to where we normally hang for both supply and demand. And we too, as far as the inventory is concerned, so demand has hit a a cruising altitude, so has the inventory. It's kind of strange. I'm sure that we're going to see, as soon as we get to the second half of March, which is a couple of weeks away, there are more homes that come on the market, then even more in April and even more in May. So I don't anticipate eating up a lot of inventory unless the interest rates go below 7%, which there is a strong probability that it does. So that is, and we'll talk about that in a minute. So the speed of the market really boils down to that low supply and low demand, match it up together, and today it's at 59 days. So both supply and demand went up 1%, and today 59 days is the expected market time. That's you place your home on the market. When are you going to become a pending sale? Not when you're going to close, but when are you going to become a pending sale? It's at 59 days. It's the true flavor of the overall market and how long it would take to absorb the overall market. Some homes sell almost instantaneously, but you have to, we're looking at the market as a whole. So what does the outstanding inventory look like? 59 days is pretty darn fast. Last year at this time though, that's the blue line, we were at 53 days. Big difference. The 3-year average prior to COVID is 68 days. So last year, it felt a little bit hotter right now. So that 6-day difference, you're saying that's not that many days, but it's enough where you can kind of feel it in the marketplace that something's off this year if you compare right now to last year at the same time period. But if you look at prior to COVID, this is actually hotter than where we were prior to COVID. It's just this is what people have gotten used to because that was 2019. That was a long time ago. We can't even remember that far for most of us with white hair. So it too, you can kind of see the expected market time. It dipped down last year and got even hotter. And that's because the interest rates went up above 7%, but they came back down below 7% for a while. And it was there all the way until we got towards July. So that allowed the expected market time, blue, last year to go even lower across the board. And some markets were incredibly, insanely hot. 2 of them off the bat, or a few of them are Santa Clara, San Diego, and Orange County. Extremely, extremely hot. Those were some of the hottest markets. And but you could see that with higher rates that we've already reached a cruising altitude at about that 59 days. Once again, another cruising altitude. So not a lot changing in the numbers. And as a result, you can kind of feel it. Not a lot of transactions taking place. Not a lot of homeowners participating. Not a lot of buyers participating. As a result, there's not a lot of transactions. There's not a lot of real estate going on. The housing market has been frozen. It's not until we see what the Fed wants. The Fed wants to see some of the economic numbers show that we're cooling, besides inflation getting into check, because they like to follow something called the PCE, and that was actually released today. It's doing the right thing. It actually looks like it's doing the right thing, but they want to be absolutely certain. I'm in the camp that they already should make a rate cut in preparation for not harming the economy further, which is what they're very apt to do, is kind of late to the party. And that's what it looks like they're going to line up to do, because they might not do this first rate cut until we hit June. They should have already done one at the end of January. They're going to meet again in March. So they're very, very data dependent. Because they're data dependent, their interest rates are extremely volatile across the board. And so when are we going to start to see a cool down in the numbers? And we actually, reports on housing with our analysis, give it like we think we're going to see it by the time we get to summer for sure. But there's like, right now we're feeling, like about a 50-50 chance between spring and summer. Give it a smaller chance towards the beyond that past summer, like 5%. So you can call it like a 47, or you can do the math. 47.5. But anyways, you get the point. About 50-50. Sometimes we think it's going to happen between spring and summer as far as this cool down. We'll see it in the numbers. And if we look at economic calendars, I invite everybody to, because guess what? All of Wall Street's watching every single piece of economic news that comes out, at least the big boys. And the big boys, you could see it. There are a whole bunch of things that you need to watch. The first one is March 6th. This is next week. ADP employment comes out. That's on a Wednesday. Then on March 8th, non-farm payroll comes out with hourly wages and unemployment. So there's a lot that comes out that's called Jobs Friday. Typically, it's the first week, the first Friday of the new month. But for March 1st, they don't do it on March 1st when it's the first day. They push it off to the following week. So we're looking at March 8th will be Jobs Friday. That's a huge, huge day. So all of these can move interest rates a lot. CPI comes out March 12th. That too will tell us a lot. I like what it's doing overall, but Wall Street doesn't like some of the noise that's in it on a monthly basis. But overall, the trends show that it is coming down, but that comes out March 12th. March 14th is PPI, and that's Producer Price Index. And just know that this is what people follow. You can go on to CNBC and you can read all about it for that day when it comes out. And you can see what happens with rates when you look at 10-year treasuries, and rates will change later on that day because of it. Retail sales also comes out on the same day, March 14th. And then we have March 20th, the FOMC, that's the Federal Open Market Committee. The Fed meets. The federal, Jerome Powell and all the minion presidents get together, and they get together for a few days. On Wednesday they have this, they release their statement, and then Powell does a Q&A, and they release where they think the short-term federal funds rate should be going forward from that point on. And they do it every quarter. So this is a big one on March 20th that we'll be watching. And we'll be very careful to listen to their language, but we'll have a lot of data points that will lead up to March 20th when they meet. And March 28th, we get GDP for the fourth quarter of 2023. And March 29th, we have the personal consumption expenditure. That's called PCE. This is actually what the Fed likes to follow more so than CPI, which is actually released today. And like I said, that one actually looks even more like inflation's in check than CPI. But they're so data dependent, and they're not willing to budge at all, that's why we keep on watching these data numbers. And hopefully enough of them will show that things have cooled a bit so that the Fed can say mission accomplished, and they start reducing rates. And at that point, we'll see interest rates below 7%. Because when we do see mission accomplished and we start to see that all the data starts to point towards that happening, we will see rates drop for sure below 7%, and then it will start to ignite more of the housing market. At that point, we will actually see that the further it gets down into the sixes as things slow further, and there's enough economic headwinds where things will slow down further, that we will see that the overall housing market, that frozen housing market melts, and we'll see interest rates come down to 6 to 6.5% as it cools. And as a result, what we will see immediately is demand will come up. It'll pick up right away. Actually, we're anticipating that when we usually peak is during the spring, but we're going to get more of a bump later on in the year because of this push with lower rates. You will get more homes that come on the market too. That's something else that we're already seeing this trend. More homes will come on the market, and the closer you get to 5%, more and more homes will come on the market as well. But demand will outpace the number of homes coming on the market. So if you like what you hear and you want to hear more of it, I invite you to subscribe to our channel, like what you've seen. Please just tap that like button. We'd appreciate it. You can go to reportsonhousing.com to learn more. You can subscribe to one of our many reports. That is actually what we do. We follow this. We present to a lot of offices and institutions, and then people subscribe to our reports. And we have them. They dot all over SoCal as well as the Bay Area. And by May, we will be in Phoenix and Vegas. And the most recent one that came out for all markets is called the rate migration. And that just tells you about as these rates have migrated up, kind of what's happened, and talks a little bit about that same thing, that 7% being a big number, as well as 6% being another psychological barrier. So if you would like to subscribe to the report, I invite you to utilize the coupon code LEAP for a free month. And I invite you also to check out our podcast. The most recent one is called Are Recession Concerns Valid? And we're actually going to be dropping another podcast next Wednesday. So stay tuned. I appreciate you for tuning in once again to another housing debrief. Happy Leap Day. We will see you on the other side and in March.